Hello, value investors. Thank you for joining me. So on Fridays, I talk about really it's kind of like beginner's investment, and it's about how to help you think through different aspects that has taken me a long time to really think about when it comes to investing. So I kind of start off with a small introduction, and I kind of talk about 2 or 3 points that I wanted to highlight to you that I think are worthwhile thinking. Open it up, and if you want to get involved and ask a couple of questions, you can do so live, and you just drop me a couple of lines and say, hey Michael, what do you think about this, that, and the other. Hello Irina. So essentially I'm going to just kind of highlight a few things that I think are very, very important. When it comes to investing, one of the biggest mistakes that I've seen investors do is to price anchor their investment. So what this means is that they say, okay, so for example, the stock has rallied significantly, and if this, I've got a problem with the buffering, that's just great. Not sure if this is going to come through. Okay, I'll just press on anyway, and hopefully it'll catch up. So anyway, I'll crack on. Okay, so when the stock has rallied significantly, investors turn around and they say, okay, the stock was at 2 and now it's at 6, and I can't see it going any further here. I can't see it doubling over the next near term year or year and a half. Now, what I will say, this is something that will tell you exactly where the stock has come from, but it doesn't help you think too much about where the stock is headed. So I always try to say, listen, don't focus on the share price, focus on the market cap valuation. Spend a lot of time trying to think. Look at the valuation in terms of what the market cap is. Think about what the peers are trading for. If you see that all the peers are very, very richly valued, that means there's a lot of appetite for that type of investment. It may not necessarily be something that you want to be buying, because ultimately the whole purpose of investing, it doesn't matter if you're a growth investor or value investor, this doesn't matter. Ultimately, you want to buy something for less than it's worth. You want to put down capital today so that over the next 2 years or so, it's worth more than you paid for. That's what you want to try and do. Now, too many investors say, okay, I like this thing and I'm going to wait for a pullback. That's not necessarily either the best approach. Again, that's price anchoring. That's saying, okay, the share price has rallied. I like this space, I like this idea, but I'm not going to be willing to deploy my capital right now. The way that I try and answer that is say, okay, try to get a feel for the possible profitability of the company down the road. Try and look at the margins. Are the margins, the profit margins reasonable? So look at the gross margins, look at the operating margins. I know a lot of these kind of high-tech companies, they're really negative when it comes to once you add back the stock-based compensation. But I ask you just start thinking through, okay, here's the gross margin. Let's say, for example, a company that I enjoy very much is Hims, for example. It has high growth margins. And when I look at even adding back the stock-based compensation, it's not significantly negative. So assuming that the business is able to continue to invest for growth and its top line can continue to grow, in time, it's very likely that this business can become, let's say, 5-10% profitable down the road. But you're not going to be able to see this right now from the financials. You would just look and you'd say, okay, I'm having to take some assumptions. I'm going to have to look out 2 or 3 years, and I have to be able to say, okay, I'm going to average into this position. Now, what happens is that once you start averaging into the position, it gets you in the mindset of you as the owner of the business. This is something that's very important, because when a lot of people kind of get into investing, they kind of, oh, the share price is going higher, but they're not really thinking through as the owner of the business. And that works very nicely when all the share prices of all the stocks are going up. When everyone is making a ton of money, it's very easy to kind of just dissociate from that and say, okay, the share price going up, I was right to make this investment. But I always say to people, think through as the owner of this business, is this the type of business that you want to own 2 or 3 years out? If you make a valid argument for you wanted to own that business, then you start putting, let's say, 2% of your capital into that business, and you wait a little bit of time. So you kind of wait, let's say, 30 days, 45 days. In that period of time, you'll get to know a lot more about the business. Your familiarity with the business will increase, because the universe has this way of just bringing you the answers when you're out there looking for them. The other thing that I wanted to talk about is about stop losses. A lot of people say to me, "Oh, Michael, share prices are falling. I don't want to be in a position that I'm losing 25% of my capital." I use stop losses to do that, to prevent against that. Now, again, having a stop loss, it just ultimately makes the brokers rich, because they make money on the transaction. The more you're kind of in and out of a stock, the more that they make money. But you, as the owner of the business, you're not participating in the intrinsic growth of the business. If every time the share price has a bit of a wiggle, you take in your position out, because it's very difficult for you to buy into a stock as it's falling. And everyone says, "Oh, wait for the pullback." But the pullback comes when people want to sell. The pullback doesn't come on the back of good news. The pullback comes when something bad comes out, something bad surfaces, and then investors are in a position that they say, "Oh, I'll wait for a better time." Here's a question. So I'm not looking. So the question is about if I would consider near-term catalysts, essentially. So catalysts work very well in the business that is kind of like under the radar, and it's kind of on its last legs often, and something esoteric is going to happen, something very specific is going to happen, and that works out for a certain type of investor. Well, they say it works out. I'm not sure if it actually does work out, but it's a different type of thing. It's not where you're kind of just looking to have something happen in a quarter, the share price goes up, and you exit that position, and then you go on to something else. Now, that trading in and out doesn't really work out very well over the long term. It works quite well over a period when the market is just going up and up and up. But the way I say to everyone, when you think about investing, think about it as a 20-year game. You want to do everything in your power to stay invested over the 20-year horizon. That's what I call the 20-year game, because I said this before, I'll say it again. When I'm writing a book about investing, and I look at the compound annual growth rates of two investors. One investor is a much better investor and is growing at 16% year over year, and he puts 5K, or she puts 5K and down $5,000, and after 20 years it's $94,000. Great, the investor's satisfied. The other investor starts with the same 5K, and they're not as good. They're only getting 13% annual growth rates, and over time they put $500, which is not a lot. Anyone kind of looking at this and talking about investing has $500 to put on the first of each month when they get their salary. And over time, over the 20 years, that becomes $500,000. It actually becomes $514,000. So this is something that anyone can do. The game is to stay investing. Really think about a snowball, but really, what is the difference between the amateur investor and the professional is when it comes to looking at a position that is falling in value, when the share price is falling, I have this rule. I don't want to exit my ownership of that business if I've held it for less than 12 months. I want to give the business time to show the strength of its business. But after 12 months, all bets are off. If I was wrong, I'll put my hands up, admit that I was wrong, and exit that position. I am very happy to sell out of something at a 30% or a 40% or even a 50% loss, and I know it's undervalued, to buy something that is even more undervalued. That's really the difference in the amateur and the professional. The professional sees these businesses as, it's not a personal thing. There's no emotional attachment to them. These are assets that can be transferred. But I'm not talking about trading and having these short-term horizons. But you can sell out of something at a 50% loss to buy something that is trading at a 70% discount to intrinsic value. And that's something that amateurs struggle to do. And this is really the secret sauce of investing, is being able to do that, because you haven't got an excess of capital. Your capital has to come from somewhere. That's what the portfolio is for. The portfolio is for you to take it from the less good positions and deploy it to the better positions. So amateurs kind of like to just, I'm going to double down. The share price has fallen 50%, I'm going to double down. And you end up with that quote that losers average losers. So it's a harsh quote to say, but ultimately you don't want to be sending more and more capital into something that is not really driving your portfolio forward. Always think about two things. Always think about the portfolio, how the overall portfolio is performing, and think about position sizing as well. So you don't want to go too aggressively into something that is very speculative. You want to minimize the risk. You want to put the maximum amount of capital into positions that are highly likely to drive forward your portfolio, but the range of outcome is quite narrow. So you want to put more capital into positions that are low risk, and they may not give you as much upside, but it's low risk, and you want to minimize the amount of capital that you deploy to speculative positions. So there's a few people here like listening to the chat, so if you kind of want to get involved and ask a couple of questions, feel free to ask some questions. Otherwise you'll just hear me ranting on, and I think that this is more fruitful for you if you kind of just get involved and ask a couple of questions. So in any case, one thing that I'm considering about is if you've got a position that's kind of, let's say, so the way I decided something is a loser in my portfolio is very simple. So ultimately, I believe that the market is more right than investors give it credit for. So I've got a stock. I own Skills. It's a gaming stock, and it's down significantly for me. So as it stands right now, I'm just in this space and I'm waiting for it to come, that I've held it for a year. And if after a year I can see that the share price is still coming down significantly, I'm saying, okay, I was wrong. Everything that I thought a year ago when I made this investment, I can see that I'm holding a 50% loss. Yes, the stock clearly now is really, really cheap, but I'm not gonna fight the market. Okay, so yeah, I lost a bit of the connection there, which isn't great. Hopefully people be able to catch back up. So essentially, someone asked me about how do I know if something is a loser. It's like, if it's down significantly, I don't want to be too quick, because you make if you're leaving yourself too open to emotions when investing. If you, for example, saying, okay, the share price has fallen 15%, I'm going to exit the moment it gets a 15% drawdown, you're not going to be investing for the 20-year horizon. You have to be humble enough to say, okay, what is achievable is, let's say, a 13% return over time, or a 15%. That's really ideal. If you can compound a 15% year over year, that's, it's an amazing return. But you want to also be humble enough and say what is achievable. And if you have a position that continues to fall over time, and you've held it and you entrenched for more than a year, that's burning up your capital. So I think that it's very important to not deploy more capital into something that is losing. That's why I always say to everyone, put a tiny bit and be patient. Don't put too much capital too early on, because you get to know the business over time. You go through a quarterly result and you write down 2 or 3 bullet points of why you think company XYZ is a worthwhile investment, and you stick to that. And when you go through the quarterly result, you can say, I thought, for example, for the sake of session, because everyone knows Amazon, I thought that Amazon's advertising business will continue to grow at, let's say, 30% year over year. And I can see that it's actually growing at 5% year over year. This is something that I was not expecting, and it's not really something that I wanted, that is aligned to my thesis, and I may not be willing to participate in this position anymore. Or you could say, okay, I thought the company is growing at 30%. I can see that actually they're growing the advertising business at 50%. So in that event, you might want to say, okay, I'm going to update my thesis. My thesis was clearly wrong, and I'm going to put some more capital towards Amazon, for example. This is, Amazon's not a stock that I own, but it's a stock that everyone knows about. So again, feel free to ask me any questions that anyone wants. This is really something that I kind of put out every Friday for about 25 minutes or so, and I just kind of put it out there for you guys. And it's really an exercise for you guys to find out more about investing if you're kind of new to investing. And I just, I know all this stuff that I'm already talking about, but I just wanted to kind of help you guys out, because I know there are a lot of people either in my marketplace that are kind of like new to investing, or the people just in general kind of trying to find their ways around portfolio management. So if my portfolio is completely in the red, I would say, okay, over what time horizon? That's the first question that I would say. So if, for example, my portfolio is like, okay, I'll give you a great example. So back last year in 2020, when it went through that March period, through the COVID crisis, all my portfolio was in the red. But I thought myself at the time, I actually wrote an article on 23rd of March saying, we are now over the worst. So on the 23rd of March, which was the absolute bottom, I said, okay, we're over the worst. I do not know if the share price of all these stocks will continue to fall down another 5 or another 10% or even 20%, but I'm very confident that from this point now, over the next 2 years, it will be higher. The share prices will be higher. I didn't know at the time that was like the absolute bottom, but I did know that if I looked out 2 years from the bottom of 23rd of March, I knew that, there's a very high likelihood the share prices are going to be higher. So in this event, it's a very, very narrow time span. It was only a few weeks that everything went into the red. So I wouldn't take it too personally. What I will say is if your whole portfolio is in the red for, let's say, 12 months, that may mean that your strategy of investing isn't really aligned where the market is headed right now. So you got to be humble. You got to say, I'm still having to learn and I'm still having to kind of think about investing and having to kind of broaden my skills. And over a 12-month period, I'll say, okay, you are not necessarily aligned with the market. At that point, you have to go back and reassess. Are these businesses high quality businesses? Are these businesses that are going to be going stronger over time? Are these businesses led by management that has a lot of skin in the game? You can just look at SEC filings and you can see under the proxy statement, there's a link there that says ownership of stock. And you can see if the management has, let's say, less than 2% of the capital, they're not really aligned with you. They're making it's like an ATM machine for them, so they're not really aligned. So try to position yourself into stocks where the management has a lot of skin in the game, because when the share price falls, it hurts you, it also hurts them. So try to position yourself into businesses where management is really, really motivated and incentivized to drive the share price higher. Hello there. I don't know this company, Sam. I don't know this company, Sam. I'm very sorry. But feel free to ask another question. Great stock, Vortex. Irina, I hope that answers your question about how to think about if your whole portfolio is in the red. So do try and kind of see over what time frame is it. It could be just that, for the last 2-3 months, things are kind of gone a bit sour. That wouldn't be a reason for you to kind of necessarily change your strategy. But over a longer period of time, I don't know Boston P, I'm so sorry. I typically try to think about businesses I typically like software businesses, although I split my portfolio in half. So half of the portfolio is kind of, let's say, the software businesses, these businesses that are growing at a very rapid rate with very strong management team. And then the other half of the portfolio is what I call the low growth stocks. These are stocks like Twitter. These are stocks that they're not necessarily growing very, very fast. Yes, I do know now. I can talk about now. That's a great now in CRM. Yeah, I can definitely talk about that. So these, like the low growth stocks, are stocks that are not growing very, very fast, but they make a lot of free cash flow, and you're not paying a lot for the free cash flow. These are businesses that I call them low growth. I don't like to call them traditional value, because all investing is value. You're deploying capital today for more capital over the next 2-3 years. So CRM and now are very, very different. I know people kind of think of them as similar. So in the case of Salesforce, I'm not sure whether that business is not already fully priced, because everybody knows it, but such a large portion of their growth is inorganic, and this has worked for them so well. Their founder has just had a terrific eye for being able to acquire businesses and being able to digest them, because a lot of times, these highly acquisitive companies, they struggle because over time you're forced into a position to acquire increasingly bigger companies. So might have been last year or probably the year before they bought Slack. So every time you're kind of buying a slightly bigger company, and you have to deal with that company culture. So that company culture was was doing something clearly very well, doing something very strongly, and then it kind of get incorporated into the likes of Salesforce, and then it kind of like, okay, now we're no longer in the driving seat, we're kind of in the back seat, and we have to kind of respect where management wants to go, and there's a conflict of interest, and it's a very high risk type of strategy. That being said, you look at the classic, which is Berkshire Hathaway, and for more than 50 years, it's been a tremendous success for them. However, in the case of Berkshire, they say we don't really offer management. We kind of, we want you to keep running your business. We just want you, if you don't want to have to deal with analysts and investors and whatever, you just will acquire you, but we don't offer management. Whereas what Salesforce is doing is a very high risk strategy, and it's worked for them very, very well. But I'm not sure. I'm agnostic. Let's just say like that. I'm not really sure how it's going to play out right now. You saw that when they increased their guidance, they reported their guidance about 2 days ago. It was just like a tiny little fraction that they really were able to upwards revise their guidance. And like they kind of the growth rates are not that strong anymore. On the other side of the equation, ServiceNow. I mean, that's a terrific business. I mean, like I can't stop speaking highly about this business. It's growing at such a rapid rate, and what's more important, so the valuation is not shocking for a business that's so well known, so well diversified, and it has approximately 30% free cash flow margins. So it's a business that is growing strongly. It does do some acquisitions along the way, but it's not really such a acquisitive business like Salesforce. And so you've got a business that has the best of both worlds. It's growing at a rapid rate, let's say 25 to 30% year over year, has 30% free cash flow margins. So, and also obviously the user, the customer, they in enterprises, and they have a 99% renewal rate. So it's such a sticky business. And if you're a customer of Salesforce, you're not going to really churn out of that. And that's just like they've done really terrifically well. I'm not sure how it's going to play out over time, because they are becoming they are becoming quite big, and there is a lot of competition in this space. So it may be, I'm unsure. So now they have this target that they want to reach. I think it's by 2023. They want to reach 15 billion in revenues. So I don't know how it's going to play out going forward. It's not a stock that I do own, but just from the side, it's something that I hear people say, and it is true that it's a very high quality business. And when the CEO, the founder, left to go and work for Nike, I was like, okay, let's see how this plays out. But the new guy that came in, it just picked up with the company culture and just kept on going forward. So it's again what I'm saying, that it's very important. You can't really qualify by looking at the financial statements what the company culture is like. And when the CEO kind of leaves, you kind of like in this period where you're kind of uncertain how things will unfold, and then you kind of like you're having to watch and see. That's why I always say, don't kind of try to get too overwhelmed into averaging into positions. So someone's asking me about Magnite. So Magnite's it's a bit like Salesforce in a sense that they are really acquisitive. That being said, I think that the valuation that Magnite trades right now is just, you can look back since February, that share price has just been tanking. And, if there was an argument to be said that the stock was expensive because all they were doing was acquiring different businesses, I mean, that argument doesn't hold out right now. Right now, the company is really trading in the bargain basement. And the other thing that I wanted to say is that if you look more broadly, so I'll just take a sip of water. If you look more broadly at the likes of, let's say, all these kind of AdSense stocks, like PubMatic or like Magnite, in the last 2 weeks or so, you look at them and they're all starting to kind of creep back up. So there was this period in 2020 where all these ad tech companies, because of the trade desk, everything got ignited higher, everything just rallied significantly. And then since February 21, all these companies that kind of went, investors were just kind of dumping them because of the assumption that they'd run up so strongly in 2020 that it must have been kind of COVID related, and all these stocks in the ad tech space kind of really just fizzled out. But as you see through, and you can look at Pariah, you can look at PubMatic, you can look at a Digital Turbine, you can look at Tremor. All these companies fundamentally are performing very, very strongly. Not only are they growing significantly on the top line, they're also highly profitable. So the market hasn't really been reflected the underlying fundamentals. So I think that there's a potential here really for Magnite. I mean, it's not a stock that I do own, but I mean, I think that that's one of the ones that I kind of keep in my mind. It's a very compelling investment. Yeah, so someone asked me about Now's net margin. So the thing with ServiceNow, a lot of these service companies is that they have a lot of stock-based compensation, and you're kind of in a position where yes, they are diluting the shareholder over time, but that's already factored in to the market cap valuation. So what I was talking to you before, I was saying that the stock is not very expensively priced. I think you have to check it out, but I think it's priced at approximately 18 times next year's revenues. And that's already factoring in the fact that all that stock-based compensation is getting diluted into its market cap. So this is something that people see stock-based compensation on two sides equations. I don't think that when you look at a company like ServiceNow, I don't think that just because they use a lot of that stock-based compensation is particularly a negative. The way that GAAP income statements are displayed, they don't really portray the underlying value of the business. So I'll give you an example, right? Back in the 70s and 80s, if you wanted to grow a business, you had to deploy a lot of your capital into building a factory, for example. And that was a lot of capital that was capitalized onto its balance sheet, and you were depreciating that factory over time. In the case of ServiceNow, they're using a lot of that stock-based compensation to reward their management team and reward the engineers. So they're investing in their sales force and in their management team. So it's a different type of investment that they're making. They're still having to invest into their business, and that's why the net margin is quite low. Going back to that example of, let's say, a business in the 1980s, if you looked at the earnings, let's say, for example, they would make a dollar of revenues and 10 cents of net income. Of that 10 cents of net income, approximately 50% would have to be redeployed into capital expenditures. So you'd actually end up with approximately 5% of kind of quote unquote clean net margins. So yes, ServiceNow is only around 3% net margins, but that other business would be priced at approximately, let's say, 15 times earnings. But if you actually looked at the underlying business's ability to earn free cash flow, you'd probably get a like for like, a very similar result. It's just the way that it's displayed on the income statement. The way that I think about it always is look at the cash flow statement, look to see what percentage of the stock-based compensation is being added as a proportion of cash flow from operations. So for example, you don't want to be seeing that more than 100% of the cash flow is stock-based compensation being added back. Ideally, depends on the growth of the business, but you want to be seeing that the amount of stock-based compensation year over year, the growth of that is less than the revenue growth rate. Because if the business is growing, let's say, at 50% and they're only growing the stock-based compensation at 20%, that's a really very rewarding business. It shows that for the amount that they're investing into their business, you're actually getting a lot of return on investment. So that's something that's quite compelling. So just think through that, and you just look at the stock-based compensation and just think as a percentage of revenue and as a percentage of the cash flow. Just look for that dynamic. Okay, I don't want to kind of bore anyone right here. So if you have any other questions that anyone wants to talk, please do jump in and ask me a question. Otherwise, I'm just going to wrap it up here. It's been great to have you guys, and I mean, I'm very, very grateful for you guys to give up some time. And yeah, so I hope to see you next time. Okay, see you soon.